Who knows what Jay-Z, J.K. Rowling, Bill Gates and Oprah Winfrey all have in common? Okay, I will tell you then. They have all overcome failure in one shape or form to go on to gain success in their respective careers. Welcome to My Perfect Failure. Join us as we delve into the world of our perfect failures. We will interview, explore, and discuss how our perfect failures can lead us to success. Join us and tune in.
Welcome everybody to another episode of My Perfect Failure. Today I'm really excited actually because we've got another amazing guest for you. So my guest today is the founder and general partner at Mendoza Ventures. After having two VC funded startups in Boston, he started Mendoza Ventures to address the funding gap in the pre-seed investment stage for underrepresented founders. So a very, very, very warm welcome to My Perfect Failure. Adrian, how you doing?
Hey, thank you, Paul. Thank you for having me. So that everyone knows, the genesis of this was Paul reached out to me on LinkedIn and we had a little rapport. And then he came back to me and said, hey, I've got this podcast that I'm working on failures and would love to have you as a guest. And we started rapping on a topic about exits and kind of rolled into an hour conversation about this. So I'm excited to be here and excited to talk more.
Yeah, absolutely. And it shows the benefits of reaching out. Because I think originally, there might have been a talk that you were doing online somewhere. I think it was last year. I happened to tune in, really enjoyed what I was listening to, connected with you on LinkedIn. Fortunately, you accepted. And then I was really thinking about a way that I could connect with you and maybe do this. And then we had that lovely conversation initially, and here we are today. So thank you.
Yeah, absolutely. And really the genesis of the conversation, to talk a little bit more about what we do and where this conversation just happened, is we have been investing in AI, cybersecurity, and fintech for now over 7 years now. We started the firm in 2016 as one of the, a venture firm predominantly focused on the pre-seed stage. Really we focus on underrepresented founders because Mendoza Ventures is both Latino and women-led. And prior to this, my co-founder and I were co-founders in tech startups. We started our first one in 2009, pivoted a company, and then had an exit event in 2015. And really for us, that was the genesis of what we built in a VC firm. We had raised VC money before. We'd gone through the process of growing companies and hiring, doing everything that could go right, everything that could go wrong. And as Paul and I were talking about this topic, it actually, out of serendipity, we had just sold a company out of our Fund 2 portfolio. So fresh out of that, when we were talking about fundraising, we really looked at the other side. What happens on the tail end of a business, whether successful exit, failure exit, and what that looks like in going through sort of the pathway of, that is part of the founder experience.
And so just to capture that, I just wanted to go back around what Mendoza Ventures is doing, because it almost feels like My Perfect Failure. There's some synergy there because of the fact that underrepresented voices, or people that wouldn't necessarily have opportunities in getting access to funding, to my mind, you guys are from that background, but you've, I guess, realized that there was a gap, there was a problem there, and you decided this needs to be addressed, and we are the people to address it. And I just love that, because you're giving people that potentially wouldn't even conceive that they could get into this space an opportunity to get into this space and flourish.
Absolutely. And I think it's, as we go through, I'll talk about one of our first exits out of our fund. But really, it's when you look at underrepresented, I don't like using the word underrepresented.
Okay.
I say overlooked.
Okay. Yes.
These are amazing men and women that just because, they're not the white guy that went to Stanford, are being overlooked because of where they live, what they look like, who they are, gender, bias, religion, you name it.
Mm.
And it really comes down to access to capital. I
Mm.
mean, I was a founder. I raised money before. I knew what it was like. And I was actually having dinner last night with a founder who, her and her husband started a company in 98, in the middle of the dot-com boom. And it, brilliantly imploded on itself. But what they learned out of that was amazing. And for us, when we raised money, we raised, during the global financial crisis. It was a very different time. So having gone through experiences like that, very similar to sort of these stories that you hear about in terms of that entrepreneurial journey, for us, we realized that a lot of these founders, these overlooked founders, it's not just access to capital, but to that domain expertise. I alluded to, you're driving down the road and you're hitting the bumps on the road that everyone else is hitting. I'm there telling them turn left, turn right, but then still building the guardrail so they don't crash the car. But trying to use our expertise of having done this before, not just in the spaces that we invest in, but having been that founder to actually help them navigate.
Yeah.
Because that, more than anything, the navigation of this journey, I think at sometimes is even more important than the money itself.
Yeah. Yeah. And well, having researched you and been, it's sort of going into a new territory for me. So it's lovely to learn and to appreciate and learn more, not just about you, but about the industry and about how it works. But what really captured me was the amount of your hands-on approach, the amount of due diligence that you do with your partners, the people that get access that you fund, and the having people that fund you that really understand your industry and can really back you, not just financially, but from an operational perspective as well. That really captured me.
Yeah. And that's actually what I say is the magic of Mendoza Ventures, is that very hands-on approach, so that when you're funding, you have a partner. I mean, for us, we had this interesting scenario. We, sort of post startup life, we would have individuals that would walk up to us and say, "Hey, I know you." And I was like, "Who are you?" And it was like, "Oh, I invested through this fund and that fund, and we were an investor into you." And my view of it was, wow, this was an incredible, amazing individual. These were amazing individuals that if I had access to them, would have been life-changing to the business. And when we started looking at the best things of venture that we could really enhance, that was that piece, that very hands-on. I mean, we invest in fintech because I launched one of the first mobile apps that went through FINRA approval in the US. I've built brokerage trading platforms on mobile devices in the last 5 years, and as we bootstrapped Mendoza Ventures, like any startup. And so when we looked at that, we were like, let's bring that knowledge that we have, as well as be an active participant. I think so much in venture capital and investors we had in the past were very passive. You saw them in a board meeting, but when, it's great if everything's going well, it's bad if, ship is hitting the fan and you need help. I mean, this isn't a passive sport. This is full contact. That's how you get to that exit. That's how you get to a happy ending, is everyone, including every investor, every advisor, has to be full contact at that early stage.
Just from your perspective, because it is a full contact, full throttle, I guess, ecosystem. What do you like that? Do you thrive off that energy, of that go, 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 go? Lots of things to do. Obviously, you're in a space that and you know what works and what doesn't work. But do you like the full-on nature of it?
You know what? I think for me, one of the things that I've seen is that the more we participate, the more that you're able to enhance what's already there from these incredible founders and help them build on it. Today, I was on a call with a potential customer, and and I don't work for the company. I mean, we're actually investing in this company,
Yeah.
and I've introduced them to the customer who could also be a potential investor. And now the customer is calling me, he's calling me, and we're just having this great conversation separately. And then I'm having a call with them together. And, yes, I do thrive off it. I love the energy when you've got the right time, the right place, because I'll tell you right now, like in startup life, we've been early to market. I've been late to market.
Yeah.
Both suck.
Yeah.
Both
Yeah.
are not great situations. But when you have that founder that is willing to take it and absorb the help and the energy, and you know that you are planting seeds to accelerate them in the next 6 months, a year, 6 years, if you put that time into the beginning, post Series A, post B round, these guys can just be on autopilot.
Yeah.
Because they have a direction. But even then, we've got a portco that I remember on the first seed round, I looked at the CEO and said, when we get to the B round, you're going to be replaced. And he was like in shock. And I was like, you've never run and then the movie hasn't even gone there. Like we're still at the seed round. And I was like, expect that to happen. Wouldn't you believe he got to the B round? They were like, great, we're going to bring in a professional CEO. And he came back to his COO and he was like, Adrian was right.
Yeah.
I'm like, of course I'm right. I'm like, that's how the movie goes. Like I've played this movie before. What happens in the second act. It always happens in the second act. And when you sort of walk through to that founder and tell them this is where the story's going to go, it shouldn't be a surprise.
Yeah.
If you've never run a company that is 10 million in revenue with 200 employees, it shouldn't be a surprise. Oh my God, why are we bringing in a professional CEO and a professional, executive leadership team that knows how to raise, $60 million and can get to an IPO?
Yeah. Yeah. It is really fascinating. I've been watching some of your content and just the mechanics and the bricks that you put together in terms of, I guess, the organizing track record, in terms of the revenue, in terms of the employees, and just all that. It's all really eye-opening and impressive in terms of how it all packaged together. I was reading something around I don't know whether this is still current, but around 70%, 75% of your investments are 75% immigrant, people of color, and women. So I was keen to ask you, what does it feel like when you're impacting not just the founders that you work with, but potentially their families and their communities? And so there's this kind of like domino effect that goes on. Do you ever take a moment to think about that?
You know what? It's sometimes I take a moment, but then that moment sometimes comes in like a Mack truck and hits you.
Really?
That's a very American expression. But the perfect example, sort of as we lead into the topic of exits, let me talk about our first exit from Fund One. And it was a cybersecurity company that was started by two brothers. And we actually did such a good job getting them ready to fundraise that to do a bigger round, that their biggest partner bought them. And it was an exit that was literally in 5 months. In 5 months of me investing in the company, we had an LOI and a term sheet for an acquisition. And I went to both of the founders and I said, look, we've got two directions to go here. We can either go the acquisition route or we can go the raising money route. And, both founders were now late 30s, early 40s. One was, on kid one was actually getting divorced in the middle of this process. And they both opted to say, you know what, we're going to take door number one. We're going to go the acquisition route. And I did a good job of negotiating that. And we'll talk more about sort of.
I'm excited to talk about that.
Yeah. And sort of roll the clock back, I would say now 4 years later, the CEO got remarried. He did pretty well out of the exit, he asked me to come to his wedding. So both my partner and I came to our wedding. Not only did we go, he actually asked me to speak at his wedding.
Yeah, wow, wow.
So now you have, his brother,
Yeah,
another family member and the VC speaking at the wedding. And at that moment, he had actually taken an art museum and rented it out. They were two Latino brothers,
mm,
and his now 40 members of his Latino family were in a art museum in San Antonio, Texas, that he rented out where he served Mexican food. And we looked at ourselves and we said, we've changed the direction of
yeah,
this entire family.
yeah,
This whole thing out of that one event.
yeah, absolutely.
And as much as that's eye-opening, it really is an honor to be able to do things like this, to be able to create that level of change. Because in the US, I would say 99% of wealth comes through M&A.
Really?
And, yes, people talk about, wealth that gets passed down, but that multi-generational family wealth that's created in M&As and private equity all comes from the buying and selling of businesses.
Yeah.
And so,
Yeah, it's yeah, and what's comes to mind as you were talking is just that shift in mindset and belief that that family community will have now. They will think about money, opportunities, founding their own businesses, totally different to what they may have done
oh,
5, 6, 10 years
absolutely.
before that.
In their case, the business was headquartered in Boston.
Mm,
One of the other CTOs was, I think, living in like Virginia or something. And they both left, went back. They were actually originally from South Texas. They came back to Austin, Texas. They bought houses there. They bought their mom their house there. And they wrote an article in the one of the newspapers in Austin that said, "Goodbye, Boston. You've been good to us, but we're coming
really.
home." And the
Brilliant.
coming home was, we are going to come, take what we've learned and bring it to that ecosystem
Wow.
along with who we've met, and start investing there and start building the next businesses there, because they realized they had this amazing
Yeah.
opportunity. What they could go back was just come back into
Mm,
these ecosystems, these smaller at that point. Austin is a much smaller ecosystem than New York or Silicon Valley. And that's really where you create the generational shift in
mm,
ecosystems.
mm.
We talk about this, that the importance of these M&As is that money that gets made in venture capital comes back as angel investments, come back into sort of more venture capital investments, comes back in philanthropies and donations of the world, of that ecosystem that you live in. And so it's really important that if you want to change or grow a tech ecosystem, you need 1 to 2 generations of those people that have had exits to be still in
Yeah.
those ecosystems.
Yeah.
Because one of the things that we see right now is, perfect. I'll talk about like Canada. Canada has an amazing AI talent. A lot of founders start their businesses there, raise money there, and then go to Silicon Valley.
Okay.
And all of a sudden, they're no longer hiring in their ecosystem. And so for some of the founders that we've had, they actually have made it a mission to try to stay as much as they can in their ecosystem. They're like, let's continue to
Mm,
hire, because if they take off and leave, and they don't come back,
yeah.
a loss for the
Mm,
ecosystem of not just dollars that get pumped into that economy, but also talent that gets
mm.
grown. Because if you don't have that generation of, series A, B, C companies, you don't have large companies that grow into these ecosystems.
Yeah, that's really insightful. And when you're working with, we're going to get into the strategy exit in a second, but just to tag on to that point, when you're working with the companies that you invest in, are you looking for companies that have got that attachment to their community and really want to, ideally, if the card should fall nicely, to maybe stay within their ecosystem, or is that really up to them? What happens with that?
I think it's up to them.
Mm,
I'm a big believer that venture capital can produce impact.
mm,
I think the future of impact is using innovation that's created to venture to grow these ecosystems. Because it would be a darn shame if we put so much money and it all went to Silicon Valley.
Yeah.
And the more that you can, I'm a big believer that there's incredible founding teams, diverse founders across the US, across the world that are not in Silicon Valley, that just need a little access to help and capital to be able to grow. And even one of the things that actually a new initiative that we're working on is a nonprofit that can build accelerators, but not really an accelerator model, but to take a small cohort of founders from outside ecosystems, bring them to our ecosystem, get them to learn, and then bring them back.
That sounds phenomenal.
And it's something we're just kicking off. When that news hits, I'll let you know.
Yeah,
but
definitely let me know. That sounds, I got a tingle when you said that, what you're looking to do. It sounds phenomenal. And what I wanted to say for people that are listening, that you guys were the first venture fund for Latino and immigrants on the East Coast. Is that right?
Yeah, I mean, it's actually, we are the first venture fund started by Latino on the East Coast. And originally we thought, well, that can't be right. There's got to be someone in New York. But now that we've been around for 7 years, we realized that when we started, we were one of the first funds started by entrepreneurs, by owner operators. When we started in 2016, that was really unheard of, to have a prior funder that had done through most of the funds that we pitched in 2008, 2009 were lawyers and asset managers. And so it became really rare for that. At the same time, that community of Black and Brown VCs was really very tiny. I could probably count them in my hand in 2016. And so because of that, what we do, actually, one of the things where we focus on trying to help fund managers, emerging VCs that are starting their first fund, to try to get them to, with help, with their back office, learning, asking questions. Because when we started, there was literally no one that we could ask. We were just starting on our own, just like how when we started with founders. But what I love that's changed in the last 5 years is there are now communities of founders, there's community of fund managers. And that same nonprofit, we're also looking at how do we do the same cohort, but for first-time diverse and female fund managers, VCs that are starting to get into this business as well. Because we realize that we've got this sort of wealth of information, including the topic of today of how do you do an exit, to be able to, really get them. I mean, I've talked to prior fund managers, like first-time fund managers, and they get surprised when we do talk to them about how I've restructured boards and companies before. And they're like, how do you do that? I want to sit and learn. And I said, you just do it. I mean, it's like, there's not rule books. It's in a case-by-case basis. But the important piece is to take what we've learned and get that out. We run a fellowship program for MBA students that are diverse and female MBA students, to get them jobs in venture. And they actually do ride-alongs with us, where they're now working with a VC and a general partner of a fund to learn the business. We've had about 16 fellows in the last two and a half to 2 years, 3 of which are now institutional investors in 3 big names. Another 2 are actually now became LPs in Mendoza Ventures, which is pretty amazing. One of them is one of our fellows who was 22, 23 years old, is now working at a private equity shop and is now an accredited investor, is now an investor in us, which is pretty amazing.
Which is, I've used this word a lot, phenomenal. I'll try and think of another word, but that's pretty phenomenal.
Well, and that's my big belief of the impact that we can do, is it's not just the performance impact of dollars and cents. It's, and this is, I think, to every founder, when we talk to them about what impact can they do, whether it's how they touch their community, how they touch other founders, the more we can sort of ingrain in them on the idea of giving back, because giving back doesn't have to be writing a check philanthropy. It could be just sort of going out to other founders to teach what we've taught them and get that out there to them as well. Because again, it goes back to that point of building an ecosystem.
Yeah. And a video that I watched of you, I think it was your Big Dreams. It was an interview that you did where you were I think you and your wife were talking to an audience, but something that you said, which again captured me, was that anybody can do this with the right disciplines and the right mindset. You've got an opportunity to explore this, and if you use the right principles, then you can find success.
Yeah, I am a big believer of this, that anyone can do this. I don't come from a finance background. I actually come from an entrepreneurial family. My dad was an entrepreneur. My mom was a bookkeeper, cabinet maker. My dad was the cabinet maker. My mom was the bookkeeper. They were immigrants from Mexico. We lived in LA, and they bought their first house in the 1970s. They taught me the ability of being on your own, starting your own business, seeing successes and failures there, what they did. So I didn't come from a background of a family that had a 401k and a retirement plan and 3 months vacation. I came from a family where it was ingrained in us the power of going out and building things. Literally, my dad built things in our house, in our backyard. He had projects that we would play in. But one of the things that it taught me was the importance of having smaller communities. I lived in a community where my godmother is now 100 years old, is a Dodgers fan living in Southern California. A great teacher lives across the street. But that power of community, of helping your neighbors. My dad was the one in this neighborhood that would go, and someone had a broken window, he would go fix it.
Okay.
He would just be around the neighborhood. He would find people that needed work and would just give them work and be like, hey, help me with this. And so really, when we became founders, so a little backstory is my wife and I run Mendoza Ventures. And prior to that, we were startup founders. And so what we learned really early on was, all right, it's about building your ecosystem around you, but also being the one that can orchestrate all of this change and all of this impact, because it's not just about what we do, it's can we lead that? Can we, be the ones that sort of create change, to be that change maker?
That's a lot. As you're talking, I'm just thinking about everything that goes into supporting the people that you're funding, the businesses that you're funding, helping them manage, organize. And I'm sure I read somewhere or heard somewhere that in any one fund, there could be up to 12 companies that you fund. So that's a lot of headspace for you to support and be involved in. I'm just thinking of me being in one company.
Yeah. Well, if you think about it, the traditional Silicon Valley model is the power law method, which is only 2% of companies will survive.
Okay.
So they may make anywhere from 60 to 80 investments. And really the genesis of how we built our model was, in order to be hands-on, it takes a lot of bodies and hands to be able to be there. So we had to limit the amount of companies. Our first fund is only 3 companies because we really wanted to be involved. If you have 60 to 80 companies, you can't do the due diligence.
Yeah.
And if you're doing them in 1 to 2 years, you're closing 2 to 3 deals a month. That's next to impossible.
Yeah.
But also, what we've seen now is when somebody hits a bump, some of these funds write them off instantly. Hands down, we had one scenario where, this company now is doing great, but when it hit a bump road, one of the funds just wrote them off. They don't even call them back.
Okay. It's brutal.
And that is how brutal this industry is, because they're focused on the 2%.
Yeah.
And it's great if you're in the 2% and you're Lyft or Uber, the 98% of loss. If you're in that pile, you're literally at that point, you're just calling it a loss because you get no help.
Okay. So it kind of makes sense. Your model can be more hands-on, don't have that huge volume. So,
Yeah.
so strategies for exit, failure or success, or how we think about strategizing. I wasn't aware that you've just had an exit yourself. So that, I guess, is definitely some synergy with what we're going to talk about
Yeah,
now.
absolutely.
So I'd be lovely to get your thoughts on the process you've just been through.
Yeah, no, it was everyone thinks it's funny because as we talked about this topic, one of the first things you and I started talking about was the fact that everyone thinks that these exits magically happen and there are these IPO exits that we read about, when in fact those are the outliers. And it's really interesting because when we talk to founders, one of the things that I do early on is I ask them about the exit. What do they think that exit scenario looks like? And there are some that will be like, I'm going to IPO this business. And I'm like, yeah, I don't think that's going to be the case. I really hope you do. But let's talk about some realistic scenarios. I remember I was at a networking event and I asked someone, if someone offered you $50 million, would you take it? They're like, no, I'm going to IPO. They have not IPO'd the business yet.
Yeah.
I'll tell you that. And that's been 5 years ago.
Yeah.
But at the same time, when you're looking at these spaces, specifically the ones we invest in, I like to tell other investors, when's the last time an AI company IPO'd? And they're like, never. So in good data science, you can't predict an event that's never happened. So what happens to these businesses? They are early acquisition targets. They are bought sub $500 million. But my view of the world is great if someone sells their business for $250 million and investors, own 20, 30, 40% of the business, and the founder still owns 20, 30% and walks away with $30, $50 million. That is an incredible outcome for everyone. Not only that, but the trickle down to the employees. We've had people that work for us in the past that I've placed in multiple business. There was one person that I know really well that I placed her in 2 businesses and had 2 exits already. And just being an employee, I mean, that alone is life-changing. Because now she can go and work wherever she wants to work.
Yeah.
And that is the important piece of when you look at sort of the thought of what is that exit. It also has to be not black and white. These processes take a while. Everyone thinks that yes, there are these, a Stripe gets bought or someone buys, and it's, you bring in investment bankers and they run through an auction process. That's great when you are a billion-dollar company and you can spend the time to do that. But when you're an early stage to a pre-seed to Series B company, this is not the process that happens for you. This is still a very high touch process, and it's unique to every business. One of the things that I'm seeing now is the IPO market is starting to be pretty closed off for the next 3 to 5 years, but early M&A in the venture private equity market is going to be really hot right now. I predicted this at the beginning of the year, and it's absolutely happening as I predicted. Even to the point that we had a company in our portfolio that literally through a relationship that I had with the CEO of another company said, hey, here's a couple of interesting companies. And we actually ended up looking at one and we decided to go down the rabbit hole. We weren't actively selling the company, but we decided to go through the process and see what happened. And that's actually one of the things that sometimes you need to go through that process. Sometimes it may be interesting to do a discovery and see if it's a right fit, but also at the same time, sometimes it goes nowhere.
So that's interesting. So that you had a chance conversation and the opportunity to maybe think about selling your selling the part of your business in the company within your portfolio in question. Was that something? Does that, in terms of what happened, is that different from what you thought the play would be when you set up that business?
It went to an amazing company. That's what I was like, what I loved. The company that acquired it.
Okay.
I was just like, holy cow, this was like the best fit ever. But normally, that process, I'll use the process of Good Dog because I've talked enough about that in interviews where it's happy to talk. I always talk about that as a good example. How that process happened is the CEO and I and one of their biggest partners happened to be at dinner together. And we were giving them an update. We're looking to raise money. And, we literally just looked at them and said, you should just buy this company. We've got a $7.5 million pipeline. And he looked at it and said, you're right. All right. And so we decided to go down the rabbit hole. It was, you show me yours, you show me mine. And we literally opened up the books and said, here's the pipeline, here's the technology, here's the customers. The great thing is they knew the founders. They knew they had, they were the ones that built the partnership together. And as they looked at it, one of the things that is really important for these early acquisitions to that acquirer is that, one, being very aggressive on not just what is in the company, what are the assets of the company, but how does it commercially fit into that acquirer? Because this is what you would do with it. And you have to treat it like an enterprise sale. You have to find the sponsor, you have to find the end user, and you have to find the person whose dollars it'll come out of. And we did really an amazing job of working with them to say, we think there is an ability to use this software as an entryway for, it was bought by a professional services company to take this pipeline of sales that has an amazing margin of 90 to 100% and then use it to drive inbound customer leads. Because, and we really were pretty adamant, and it actually ended up working out that we had a couple of use cases where the CEO had done a good job saying, well, look, I've got professional services that we have a 20 to 28% margin. This is a good fit for you. And you know what? A year after acquisition, that pipeline converted. And they saw it happening, and everything that we predicted came true. And that's just the really important part of finding that use case, especially when you're finding a strategic buyer. Because here's the thing, and this is what's happening now, and I see this now in this ecosystem. There's people that are struggling to raise money. There's people that are struggling to find customers. So as that founder, having tough conversations with them, and I do this, I have these conversations with founders that even are not portfolio founders, even those in the ecosystem, to ask them, well, I think you should find a strategic acquirer. You should find someone to take the team, the IP, the company, and roll them into someone that is well capitalized, that needs what you have.
Okay.
And that really, as you're looking at what success, so, really for when we talk with founders, we ask them this question about what is success. I mean, everyone is so concerned about success, but at the same time, you also have to talk to them about what a failure is. Burning through investors' money, and we've seen so many cases out of Silicon Valley now where nothing happens. Like, millions and millions of dollars are spent, widely publicized cases like Theranos and everything else that you see at Silicon Valley, where nothing comes out of it. And that's really sad because, not just does it affect the founders, but it affects investors. It also affects ecosystem, but it also affects the families of those early employees that are there.
So just around that, do you think that when founders get together and they're going to start their business, should they have almost two models, like or two looks? What does success like? And obviously there can be that can be broadish, and what does failure like? Again, that can be broadish, but essentially you've got two pots that you can consider, and you just got them there as guides to keep you going. Because like the example that you reference, when a business maybe isn't doing so well, you can go and you can keep on burning through investors' money, or you can, the option that you described that hadn't occurred to me before, that you can maybe look at a strategic partner that actually needs the services you've got and can actually do something with your business, and then you've got a really, that's a successful outcome if your business isn't performing.
Yeah. Well, it's funny because as a founder myself, I raised money in 2008, 2000 into 2010. We were always asked the question, who is the acquirer? And because of that training, even when I do that, even when I look at companies now, I get asked about who is the acquirer. Happened even today. Someone asked me, who is the acquirer? We always keep a list of who we think the low-hanging fruit acquirer. But if maybe the business hits a couple of metrics, a couple of products, who it could be, whether it be a small strategic, whether it be a bigger player, because acquisitions happen in, I would say, three different ways. There is, I want to, a build versus buy scenario. I could build it. It's easier that I buy it. Then you, at this point, you bring on team, you bring on dollars, you bring on IP, and it's a win-win for all. There's acquisitions that I've seen, that I've known some founders that were acquired to take them off the space. And guess what? In some cases, the acquirer never uses the IP, never uses the team. They just get acquired. It's a happy ending, but then nothing happens. They literally buy them to take them off the playing field.
Can I ask a question around that? So what does that look like? Is that a success? Is that a failure? Because if you sell the business and you 5x, 10x your return, obviously that the fiscal number is wonderful, but in terms of what you've put into that as your business, and there might be some legacy undertones that you might want to see in the future. Do you just have to manage our expectations of what's possible, and maybe from my perspective, maybe not have such a rose tinted view of what the legacy of the business might be?
Well, part of it is how I would answer it. It's not a why, it becomes a how is the business acquired? Because I think everyone thinks that the acquisitions are all cash acquisitions. Everyone gets cash, everyone parts ways, everyone has a great time. And the reality is that sometimes they may not be cash acquisitions. Sometimes they may be, and I would say there's three spectrums. They full on, I'm going to buy you in cash. I have seen scenarios like that. Someone buys, and I remember a scenario early 2016, 2017. A company was in the mobility space, and this company was bought for $80 million instantly. One founder, the acquirer never used any of the technology, but the founder walked away with, $75-80 million. Good for him. That founder ended up buying a sports team.
Oh, really? Wow.
Yeah. Oh, yeah. Completely crazy. And then the other side is that it becomes a stock deal.
Okay.
That it is, you're now being acquired by a larger corporation, a larger business, where you're not doing due diligence on the company that's being bought. You're being on the company that will be bought. And as an investor, you now have to sit there and say, well, am I trading up or am I trading down? Because if your goal of the investor is having some return, if you get bought by a publicly traded company, or at least, very far along, is it a good return for you? Is it a 1x? Is it 2x? Is it 5x? If you're getting stock in a publicly traded company, will there be opportunity to grow? Maybe not. Maybe the value of what your outcome stays flat. Maybe sometimes it's, 1+1 is 3. And, by acquiring that company, that other next company really like drives revenue and increases the valuation. Or the case of, someone sells a company into stock into a company that may not have a great valuation and then slides lower. I've seen examples of that happen as well. And there's also this middle ground, what the PE shops do, which are majority buyouts. They buy 50 to 51% in cash. In that case, it's a liquidity event for all the employees. And then they get that second bite of the apple where they still own stock. I would say 50% of the time it's great. There's another next liquidity event in the next 3 to 6 years. 50% of the time, that private equity shop drives that company to the ground, and there goes the value.
Okay, so it can be quite varied. So when you're working with your teams, that sort of companies you're funding, I would imagine that in numerous cases you've got more than one founder. So do you have to so when you're working with them, are you looking to make sure that they're on the same page in terms of what an exit could be? Or
absolutely.
Okay.
From the get-go.
Okay.
The founders that we bring on are like, we think this is an early acquisition. We think it's going to go to A, B, and C, and we think there's a potential of it going to D, E, and F. And when we do the due diligence, very early on, we bring that up. Okay. Is this the founder that says, no, I'm going to IPO this regardless? And you're like, but you're an AI company. You're never going to IPO. Or there's the founders that agree and say, you're right. We agree with you that this is an early acquisition target. And here's who we think it may be. And when you start from there, guess what? You quickly start looking at building those relationships.
Yeah.
Potential partners. So it's, and these types of acquisitions just don't happen overnight. They have to build relationships because you want to be able to say, yes, they may be a breakout star that will IPO one day, but you also need to hedge your bets in case it doesn't, and to have these strategic, investors, customers. Like right now, I'm actually working on the financing on a company, not public yet, where I'm actually trying to bring in more strategic customers to also be strategic investors, because those banks, credit unions, financial institutions may one day in the next 6 to 8 years acquire that company.
Yeah. What I love about what you do and your expertise is that you can almost vision when you're working with somebody that what they do, where they're positioned, their expertise. I almost see that you've got this sort of jigsaw of people. They need to be speaking to these people. They need to be speaking to these people, and you can just help a successful conclusion.
Yeah, absolutely. I mean, part of the power of it is to sit back and look at how these relationships are made. This is, I like to say in venture, 25% is writing the check. 75% it's a relationship business, whether it be other investors, whether it be other founders, whether it be other partners, and you're just taking one thing here and everything. You're just trying to
connect the dots. Yeah.
And that's actually the success of a really good investor, is can you help connect the dots, where sometimes another investor may not see it, sometimes a founder may not see it. But if you can do a good job of connecting the dots, that is the power of success, is making sure that, the dots are connected, and also making sure that there is a clarity.
Yeah.
I remember one day, one of our founders out of our first fund happened to be out and about, and he looked at me and said, I could never do what you do. And I said, why is that? He's like, he said, I would be too attached to these companies and these founders. And he said, you just have this overall view of the world where you can make a clear decision without having that years of things. And I said, that has to be a good investor, is you have to make a call or make a decision that's not emotional. Because yes, you're going to affect people's lives. Yes, someone, may get offended. So when, I like to say, whether you hate me or you like me, you know who I am. And that is the importance of making that clarity of decision where, you're not sitting in the business every day. You're not dealing with payroll or P&L. You're actually above that, and you could build those relationships quickly. And whether or not they don't see it, but you're there to sort of make these connections, whether it's hey, I have a potential customer here and I'm going to walk down the rabbit hole and see, or also, why don't we have a conversation because we think there may be a play for a future acquisition here, whether it's now, whether it's tomorrow, whether it's next year. And that actually was how that second business got sold, is we had someone that was in my network where we just said, I think there's an opportunity here. Saw it, and then the founder and I synced up and he said, you're right, there is an amazing opportunity here. So I said, great, well, how do we get there? How do we make sure that we have that vision of what we think this acquisition looks like and get it to the point where as we get to that acquirer, and it happened to be the acquirer had actually also had that vision as well. They were like, you're right, I actually was thinking about this. And we kind of put both of our visions together to make that acquisition happen.
Yeah, it's phenomenal. And I see the value of relationships, making sure that you've got that ability to nurture not just relationships, but the right relationships. Because if you go down the wrong road, then clearly the outcome won't be the outcome that you want. But for people listening, that this is music to their ears in terms of things that they can do, are there really obvious things that can be detrimental to a successful exit in your opinion?
Absolutely. I think for the listener, for that founder, the most important thing you can do is, I think there's two things. One is beginning to look with that clarity on the business and have that library of assets. What do you own? What do you have? Tech stacks, and keeping that always in your back pocket so that you know exactly what you've built, where the money's gone, what the team looks like. And that actually, surprisingly enough, for most founders, is the homework that they have to do when they're starting to think about this. But even that's the important homework, that even if you're raising the next round of funding, you should be able to quickly produce a list of what your assets are. What are the things in value that you have? I was actually talking to one of our portcos that had actually got an inbound interest. And I said, why not? Let's actually, why not? Let's see what happens. And we started to look at the mechanics of what that would look like. One, it's figuring out what you have as assets, but also at the same time, pricing the asset as well. Cash is cash, that has an obvious price, but if someone is interested in buying the business for cash, there may be a value to it. It might be a 2x value to them. It might be a 3x value. There is then the IP, what you've built, tech stacks, branding, marketing, and then assigning a value to that. And then the third one is the team. Who are you and what are your expertise? And if you were to hire that team and recruit that team, what is the cost associated to that? So that's the first point of any founder, is making sure you have that assets. And every financing round, every 6 months, you refresh it as an exercise with the executive team and the founders. Because there is, the value that someone has put on the company because of raising money, but what is actually the value of the company? All right, if you're valued at $50 million, how do you actually have that $50 million? Because we've seen all sorts of crazy things from people saying, hey, no, I actually have this thing, and I think it's, and you're like, wait, this is totally unrealistic. You have to be realistic when you do
Well,
this.
there was that recent, I say recent, I think last year, was it JP Morgan, that girl that she sold a whole bunch of things and it wasn't real. I don't know if you're
Oh,
familiar with
absolutely.
that.
They
Yeah.
were, it was, I think, Go Henry, and they were fake identities.
Yeah.
They were created for users,
Mm.
and they bought it for the users and realized they couldn't monetize them because they were fake.
Yeah.
And so, that is on the acquirer to do that due diligence, but also, they bought it for customers. And sort of going back to those 2 points, the second point, which I think is the dangerous one, is for a founder it's great if something comes inbound, but the founder that is actively chasing that can waste a lot of time. Because especially if they're not surrounded with advisors or board members or investors that have gone through a process before.
Okay.
And surprisingly enough, most founders have never sold a business. Most investors have never sold an early stage business as well. And those founders get a lot of bad advice. They start hiring iBankers for a seed stage or a Series A company. They start, thinking that they're going to, sell this for $1 billion. And it's like, guys, like, what are you doing? Focus on the business, focus on the revenue, and then the business will come without that strategic sort of connection to that acquirer. Because we also see in a lot of spaces, and this is good for sort of every listener and every founder, is we find founders that will come up to us and say, oh my God, like the infamous one, Match.com is going to buy this. Oh, really? Match.com with, 100 million users or whatever is going to buy you. Oh, that's amazing. And the first thing we ask is, where's the LOI? Where's the letter of intent? And they're like, well, they said it in a meeting. Well, they said it. And it's like, no. Come back when there's a letter of intent, when there's something on paper that says, I am going to buy you. It is this much. And this is what we're going to do. Guess what? I never see the letter of intent. And even when one of our founders, I give them the same advice, like, get a letter of intent. Someone prices the asset for you. And then, because when you look at the process, everyone thinks these are, again, hey, someone writes you a check, you go home, everybody cheers. It is a long process because you get to a point where you both agree that there's something there. The next stage is a letter of intent. The acquirer has to send you a letter that says, I would like to buy it for this much and this much, and this is what we're going to do with it. And that's the important piece. And you may negotiate 3 to 6 months on that letter of intent, on what the price is, what the terms are. There are no deal docs yet. You're just negotiating like a term sheet.
Sorry, carry on.
Yeah, go ahead.
No, I was going to ask, could you almost have a checklist when you, even at the start of your journey as a founder? Obviously, you don't know how long that you don't know what the timeline will be, or maybe you can have a projected timeline, but could you almost have a checklist from start to finish, and then you can just plot the stages that you're at, but also you could morph in the steps or the actions that we need to take?
Absolutely, there is a basic skeleton.
Yeah, basic skeleton. That's what I was.
There is, the intro, there is the LOI, there is due diligence. That's an important thing, is at a certain point, you have to, open your cards up. In between that, if you sign the letter of intent, there should be an NDA in place. And this is actually where a lot of things fall down in that important gap. Like I was just talking to someone yesterday that said, hey, so-and-so is interested in acquiring so-and-so. And I said, great. Well, and they asked this founder not to talk about it to anybody. And I'm like, this sounds sketchy, because normally you have a team, you build a team around you. It's not just you as a founder. A lot of times you will see potential acquirers that go to early stage startups and do that. And so that they don't talk about it. And they may use it as leverage to buy somebody else and have a bake-off. And the advice that I gave him is tell that founder that, say, yes, I'm happy to do that. But if we don't do a deal, there's a kill fee.
What's that? Sorry.
So kill fee is, and this happens in some acquisitions, is that some founder, some acquirers may say, hey, I want to have an exclusive. That means you can't shop it around. You can't shop this deal around. Like a term sheet. Think of it as like a term sheet where you have exclusivity to that potential acquirer. Well, if I'm giving you exclusivity that I'm not going to shop this around, if you don't buy it, I want dollars as compensation, which is a kill fee. And that may be, actually, I've seen these go from anywhere from like 60,000 to 6 million, where someone says, well, you're wasting our time, so therefore there should be some monetary compensation if you make us go through this process and nothing happens.
So that can flush it out pretty quickly.
Yeah, absolutely. You also will use that to flush out whether or not someone's serious or not. And sort of first step is put an LOI. Tell me you're serious, negotiate it down, then tell me you're really, really serious. And then once we've passed basic terms, let's sign NDAs to start, and some people will sign it before the LOI, but, then, the real one should be when you now open up the kimonos, and they have to open up on both sides. You as the target need to open up your books, your finances, your users, all of that. But also the acquirer has to open up their books as well. If this is a stock deal, you've got to make sure that you're doing due diligence on that company. If it's a cash deal, you've got to make sure they actually have the cash.
Yeah.
Or waving paper money around, or they have to, in some cases for these businesses, that acquiring company may have to go raise those dollars to make that acquisition happen from investors, from iBankers. So you've got to make sure that, all right, if it's a cash deal, do you have it? If and if you don't, how long will it take you to get it? If you have that stock and you're going to offer me stock, then what's the value of it? What's the value? If you're a publicly traded company, has it been trending up or has it been trending down? And am I getting it at strike price or am I getting it at another price?
It sounds actually, do you find it personally, when you go through the process of an exit, do you like the process of ticking all the tick boxes that need to be ticked? Because the way that you describe it, because this is all new to me, so I'm learning as I listen. And also I'm thinking about when I hear in the papers or I hear in the news that a company was looking to sell their company to a prospective buyer. The buyer suggested that they have all the cash, but when they get down literally to the wire, it turns out that particular buyer doesn't have the cash, and it was all made, not a hoax. I can't think of a better word than
Open
that.
mirrors. Yeah.
So, but the way that you've described it, and sort of in particularly the detail, do you like the kind of the investigation?
Well, I think as an investor, you have to be a fiduciary. As the board member, as the founder, you are a fiduciary for those shareholders. So you have to go through those things, because the worst thing is the same thing. You go through this 6 to 9 month process and there's no cash at the end.
Yeah.
And that I see happen a lot because they're not doing the right due diligence on both sides. It is literally mutual. It is going back and forth, be able to say, hey, you really need to open your books up to me. Are you in the negative? If the acquiring company's in the negative, they don't have the cash to buy you. It's different if it's a publicly traded company, but if it's a larger, venture-backed startup or private equity-backed company and the cash isn't there, you've now gone through this thing and and the business has suffered because, I've seen cases where people will go through a process to wait the startup out. and see if they run out of cash.
So say that again. Sorry, they will do what? Sorry,
Literally to wait the business out and have them run out of cash and then buy them at a cheaper price.
So if you're the business, if you're the founder, and you're in that position and waiting for you to run out of cash, is there anything you can do about that?
Well, I think as the founder, the goal is to look at how serious this is. Like, and also at a certain point, pull the plug.
Okay.
And quickly be like, this is not going to happen, or it's not, or it is going to happen, or find another buyer. Like,
Okay.
because here's the thing, the power of it is once you have a term sheet in hand, doesn't mean you can't go to the next strategic partner and say, I have a term sheet in hand. Someone has priced the value as this. Because even if it's a stock deal, there is a value to the company that someone else, I mean, think of it as like a term sheet, like any funding term sheet, an outside party has valued the business. Doesn't mean you can't walk around and offer it to somebody else. And that's the same thing with the power of the LOI, is to find the right buyer that fits for you. Because if it's a good strategic buyer and you go through the process, because even if you continue to go down the process, going down that checklist, there's still multiple steps to make this process happen. After due diligence, you then have to actually, go back to your board and your investors and say, we have a deal. We have a signed LOI. We've gone through, you've got to make sure that everyone is eyes wide open. Investors, employees. Then finally, when the board approves it, the shareholders approve it, then you can start deal docs.
Yeah.
And acquisition paperwork. And that actually is fairly mechanical.
Okay.
It should be mechanical, but like everything should be in place. The due diligence on both sides, as early stage founders realize that they have a lot of power. Because we were, in the case of Good Dog, we did an amazing job of negotiating for these founders, to the point that like the opposing counsel was like, man, you guys did a great job. And that's actually what a case is. This is a interactive process. This is not a passive process. This is a full contact process, because the worst part that you could be in is to have run 6 to 9 months and then get surprised at the end.
Yeah. That would, if it doesn't back out at the end, that must be beyond demoralizing.
Also, the important thing for any early stage business is that if you think with 1 month of runway, you can run an acquisition process, that's next to impossible. If you want to run a process like, or 3 months of runway, like it doesn't happen in a month.
So what is there an average runway? What might that look like?
I think it's having 6 months to a year of runway, where you can, where you're planning to run the business. The best acquisitions are, look, I'm running my business anyways. If the offer is the offer, great, but I can still have a backup strategy, which is continue to raise money, run my business. It's much harder when you're looking to crash the plane. But you know what? It's possible too. Yeah. And that's why you do the legwork by having these partners and relationships ahead of time, so that if something bad happens and you have to crash the plane, you have those 3 to 6 months of relationships of people that you're nurturing. But to be cold, hey, I'm cold, I need to sell the business, divest the business. Usually in the examples that I've seen it doesn't go well for the founder.
And for people that are listening, and maybe in your experience, when we're looking to exit, should we have an exit team?
An exit team?
Yeah, so people that that are going to be part of that strategy to ensure that the exit is successful. Are there players that you would want to have as part of that exit strategy, if that kind of makes sense?
So I think for early stage businesses, hiring an investment banker doesn't make sense. I think it should be advisors and board members that are close to the business, that know the business, that know the ecosystem, that understand who these potential acquirers are, and can make things go faster. Because the hard thing with the iBankers is, a lot of them pitch a great story, but they're great when you're at a series B, C, D, and you're generating 20 to 60 million in cash flow. And then that, auction process is fairly mechanical. In that case, they're looking for things, they're doing market analysis, but they may know the business. They do not know it as well as a board member or an advisor or the founder that has been with the business for 2 to 3 years, understands the customers, understands the partnerships. And that's an important piece, is to find people that are close around to you as the founder that can help with that process.
Okay. So can I ask a question around that? So in that case, when you're structuring your business, would you really identify people that have those types of skill sets to actually join your business? So when you eventually do go to exit, you've pretty much got the right people in place that can help facilitate that.
Well, this is why for me is having advisors is really essential. And one of the things when we come into a business, and every founder has a slide of advisors, some from 8 to 10, some from 4. And I actually go through the list of people and I'm like, are they an investor in the business? Have they provided you with a customer? If the answer is no, when's the last time you talked to them? Because even in my story, I had, advisors that would take a cup of coffee like every other quarter. And I'm like, okay, you're not very helpful. But the best advisors was the ones that I talked on a monthly basis, on a weekly basis, if I had to, that I could take things to them because they had that sort of clarity view, that sort of view outside of the business, to be able to look at what we were doing, whether it be technical architecture, whether it be go-to-market strategy, whether it be customer success plans, whether it be contracts, to pull different experts from the field. And for a lot of our businesses, what we do is find a core group of advisors that you trust, you love, that are active with you. Because if you're offering them, a 1/4 to 0.5% of the business, they need to be very active. If not, get rid of them.
Yeah.
Secondly, is building customer advisory councils of customers that can talk to you about, go-to-market strategy, product strategies, product roadmaps. Because let's say you have a good group of core customers and you actually, are trusting with them and they know the business too. When, let's say you decide, hey, I think we may need to sell the business, you now have a line of sight to potential customers that may be acquiring the business and acquiring the team and acquiring the IP because they're actively involved with you. And that's why the more you can put in place to build those resources around you so that it's not cold. Your first thing, if let's say you're a founder and you have some semblance of product marketing fit, but either you're not raising money or you're in like something else happens, yet you have a customer advisory board, you can literally then go to them and say, here's what I'm thinking. I'm thinking we're going to, divest the business. Are you interested in buying it? But, what works there is they have customers, they know the founder, they know the business, they have a use case in mind already. And then with the help of good advisors, can now put a strategy together. The failures that I see are the founders that think they can do it themselves.
Okay.
Without ever having run a process before, that is 10 times harder, because what they don't know are the surprises that are usually the things that they have not encountered.
And just around that, founders that would want to go down that road and do it themselves, is that ego? Is it, I don't know, why would you Because obviously, if you don't do it, because the cost of getting that wrong when you're selling your business is astronomical from a financial perspective.
Well, and also from a team perspective.
Yeah.
You have, families on the line. You have people that are working for you that believe in you. I think it's mix of inexperience and a mix of ego. The most important thing in this thing is to have that advisory board, that have that advisor. So we as a fund have an advisory board that we run by them in terms of strategies. Hey, we're looking at these spaces, whether they're providing guidance on macroeconomic view, macro view of certain verticals, as well as like how we structure portfolio construction. You as founder should have a group. Actually, in one of my businesses, one of the startups, we actually had an advisor that, when we said, hey, we want to sell part of the business off because we're pivoting the company, he actually was able to knew the business. We had built a few things for him and was able to take that and say, hey, I actually am going to bring it to my company because you built something for us, and talk about how do we acquire that asset. That I think is synergistically to the CEO or operator of any business to make sure they're laying the groundwork, but also have those relationships, those warm relationships ready to go. And that's why I said when it's very hard for a founder that may not know how to run the process, but doesn't have those in place, that is next to impossible to get to an exit.
So I see that from the way that you've explained it. So if you build these relationships into your business, then when you jump from one step to the next, you've got the right relationships, processes in place that it should be as seamless as it possibly can.
Yeah, because even if you don't go through the exit, that advisory group should help you find customers.
Okay.
That advisory group should help you find potential investors. And that should be the power. I mean, that's actually what we used on our business. We had an advisory council that we had one member helped us introduce us to 5 different customers because they knew this person, he was a brand name, and they were part of his circle. So it was much easier to have a relationship with customers than trying to knock on the doors from scratch. And that's, I think, where if you do it right and you have this outside view of the world to be able to help sort of, with these either an acquisition or customers or, hiring even advisors are really integral to this, because you need that outside view in to just help you navigate the complexities, because again, it's like you never want to say, hey, we're going to crash the plane, but the more you can have, because I like to say, with early stage startups, you're flying and building the plane all at the same time. The more background you have to help in case, what if there is no product market fit? What if you're late to market, to be able to have an exit strategy?
Yeah. So I've learned so much. It's almost like a 101 of exit strategy, success and failure. And there's so many insightful and helpful things that we all can do to mitigate the more of the challenging exits or the unsuccessful exits, which can really easily happen, I imagine, if you don't have these core things in place. And like you said earlier, particularly if you don't have the experience, you haven't got the right people around you, maybe you don't have your ego in check, then if those things are out of sync, then clearly your exit experience isn't going to be a good one.
Yeah. I mean, it's trying to, I have this saying, and you can learn this from me, is I only make a bet that I know I'm going to win. And so whenever I'm in the room and I say, I bet you, someone says, don't take the bet, because he knows he's going to win. And what you as the founder need to do is to be able to make those bets that you're going to win. And it really is positioning all of those blocks in place so that you have them.
Yeah.
You know, you have building blocks in place to help you. And it's, you know, sometimes it's technology, sometimes it's dollars, sometimes it's people. And the more you can build that around you, the more, you know, you're sort of building that success, but also you're mitigating the risk of failure. Because, you know, I like to say it's only failure if you don't learn anything.
Yeah.
You know, because even if you have sold the business, but you didn't learn anything out of it, you know, was it really a success or was it a failure?
Yeah, absolutely. Yeah, there's always every situation, good and bad, we learn. If we don't learn anything, then we really need to sit down and think what happened, because there's always something that we should be doing proactively after, good, whether the experience has been good or bad, because that's what we should be doing. I'm conscious of your time, and I've really enjoyed this discussion. I've learned it shows the benefit of reaching out randomly to people on LinkedIn and hope they respond, because this has been a really invaluable and really insightful. So thank you so much. I just wanted to ask you 2 more questions. One, where can people reach you and find more around what you guys are doing at the moment?
Yeah, absolutely. Find me on LinkedIn, Adrian Mendoza on LinkedIn. We've been pretty busy, so I may respond, I may not respond, but I try to respond to everyone that I can if it's a good fit. Sometimes if you do want to reach out, always craft a unique message. But we are pretty busy, so I have still about 500 LinkedIn requests I'm still working on getting to. Oh,
you're just a little bit busy.
Catch me at a good time. You may not be able to catch me.
Yeah, appreciate you're very busy at the moment. And what else I don't want to ask you? So we always have a recurring question on the podcast, which is, if you could invite 3 inspirational people for dinner, they can be alive or they can be past, who might you invite?
Oh, I was thinking about this one when you asked me, just because I'm a ridiculous person and I just love to see what happens. I would invite like Bill Gates, Abraham Lincoln, and Pancho Villa to dinner and just see what happens.
Just see what happens.
3 diametrically opposed individuals, just to see what happens.
That would be amazing. I think it'd be interesting actually to do that maybe one time, just invite 3 very different people to dinner with definitely conflicting thoughts and stuff, just to see what happens.
Conflicting time periods, conflicting thoughts, conflicting hats.
Yeah, that would be phenomenal. Adrian, thank you so much. I really enjoyed this discussion. I've learned loads, and it's one of those ones that if I wasn't talking to you, I'd been writing down. I was writing down notes anyway, but if I wasn't talking and I just had to concentrate, I'd be writing down copious amounts of notes, because there were so many takeouts there. So thank you so much. And I'm sure everybody that listens to this, particularly if you're looking at your exit strategy, successful, it should be successful now if you just take half of the takeouts that we've got from this discussion. So thank you so much, Adrian.
Thanks, Paul, and excited, and I'm glad you reached out.
Thank you. And thank you, everybody, for tuning into this episode of My Perfect Failure. We're always looking to grow the show, so please do share this episode far and wide, particularly if you know people that have got their own business and they're looking to, or they've got their own business and potentially at some point they're going to be looking to exit. This is a must listen for them. And your feedback is most welcome. So we're keen to hear about things you like and equally things you don't like. So you can find me at paul@myperfectfailure.com, or you can find me via the contact page on the website. So take care for now. Bye.
Thanks for listening to My Perfect Failure podcast. Be sure to visit www.myperfectfailure.com to join the conversation. Subscribe to our podcast on iTunes or Google Play. Look out for our next episode.